Welcome to Hearts of Economy. Today we are diving into a financial picture that looks like a red alert. The Fed is cutting rates, gold is hitting new all-time highs, Bitcoin is surging again, and Wall Street stocks are climbing to historic records. But here is the real question. Is this the start of a brand new economic era? Or are we living inside one of the biggest financial bubbles of all time? Let's break it down step by step. In recent months, the Federal Reserve has shifted course. After years of high interest rates to fight inflation, the Fed has now begun to cut rates. Normally, this will be seen as a health signal. Inflation cools, rates come down, and the economy gets breathing room. But this time, the reaction has been extraordinary. Almost instantly, gold hit record highs, Bitcoin exploded upward, and the S&P 500, Nasdaq, and Dow Jones all rallied to new peaks. This synchronized move suggests not rational pricing, but rather over-exuberance. In my view, while the Fed's intent is too soft and landing for the economy, investors are reading this as unlimited liquidity is back. That mindset is dangerous. History shows us that whenever markets believe liquidity will flow forever, the hangover is severe. For thousands of years, gold has been the ultimate safe haven. Typically, when gold releases, it means investors are seeking safety from risk. But today, we see something unusual. Gold stocks and crypto are all hitting highs at the same time. This contradiction tells us something deeper about investor psychology. On one hand, there is a rush for safety through gold. On the other, there is aggressive risk-taking in equities. The most important factor here is China's gold reserves. China has been steadily increasing its official gold holdings, signaling a strategic move to reduce dollar dependence. The big players are clearly hedging for long-term uncertainty. Still, in the short term, the surge in gold looks less like a structural trend and more like a liquidity wave flooding into every asset. If the Fed slows or reverses course, gold could face sharp corrections. Bitcoin has become the star of this rally. For younger investors, Bitcoin is not just an asset. It's almost an ideology. Whenever the Fed cuts rates and the dollar weakens, Bitcoin reacts instantly, and that's exactly what we're seeing now. But let's be clear, Bitcoin is far more volatile than gold. Gold carries millennia of trust. Bitcoin, in contrast, is barely 15 years old. That makes it vulnerable to violent swings both up and down. My take? Bitcoin will thrive on this liquidity wave in the short run, but for it to truly establish itself as digital gold, it needs more than price spikes. It needs real-world adoption and structural utility. Right now, much of the rally is euphoria, not fundamentals. Now, let's talk about equities. The S&P 500, Nasdaq, and Dow are all at or near record highs. Tech stocks, AI-related companies, and growth equities are leading the charge. Bank of America's chief strategist, Michael Hartnett, put it bluntly. This is a bubble and the bubble is still inflating. Historically, major bull markets often last 8 to 10 years before collapsing. Today's rally looks strikingly similar to the dot-com bubble of 1999. Back then, the story was a new economy. Everything looked unstoppable until Nasdaq lost 70% of its value in 2 years. In my opinion, Wall Street today is fully where it's in a bubble. But the mindset is, let's enjoy the ride until it bursts. That is incredibly dangerous psychology. Everything feels fine until everyone runs for the exit at once. And when that happens, panic sets in. China deserves its own chapter in this story. On the one hand, official authorities are aggressively buying gold, adding to reserves at record pace. This shows long-term strategic caution, building protection against dollar dependency. On the other hand, individual Chinese investors are doing the opposite, selling gold ETFs and rushing into stocks. Why? Because equities promise faster, more exciting gains. This split reveals two critical truths. Number 1. Governments hedge. They prioritize safety and stability. Number 2. Retail investors chase. They follow greed and momentum. Whenever greed dominates caution, history teaches us that a crash is never far away. Michael Hartnett suggests using option strategies like call spreads to benefit from the bubble while staying hedged against downside risk. My simpler advice: don't chase everything blindly, diversify. Keep positions small in highly volatile assets like gold and crypto. Most importantly, don't fall for the myth of permanent bull markets, because no bubble in history has lasted forever. When it bursts, even so-called safe assets get crushed. So where does this all lead? There are two main scenarios. Scenario 1, collapse. Liquidity continues to fuel a massive rally, but eventually inflation comes roaring back. The Fed is forced to tighten again, and markets crash violently. This will look very much like the dot-com and mortgage busts of the past. Scenario 2, a new era. Technology, AI, and digital transformation truly reshape the economy. In this case, today's rally is not just a bubble, but the start of a structural bull market, perhaps the beginning of a new financial age. My view, reality will likely fall somewhere between the two extremes, but one thing is certain: this moment will go down in financial history, either as the dawn of a new age or as the biggest bubble of our lifetimes. So to recap, the Fed is cutting rates. Gold, crypto, and stocks are all hitting record highs. China is hedging long-term risks while its retail investors chase quick gains. This is either the opportunity of a lifetime or the final act of a historic bubble. What do you think? Is this a new age or just another bubble waiting to burst? Let us know in the comments. Don't forget to subscribe to Heart of Economy, like this video, and turn on notifications. See you in the next episode.